Hello, Marc Ostwald from ADM Investor Services International. With some thoughts on markets and market reactions in the wake of the as yet undecided US election. I think there are some important points actually here to make, because we're in danger of falling into the same old trap that we've been doing for two to three years, whereby we get a market reaction and some price volatility, and then we try and fit the events in a backward-looking way onto the price action, and sometimes actually that creates a very, very false narrative. So the first thing I think to remember here is, where are we in terms of market implied policy rates? So my first table chart today is the familiar one, which essentially highlights that outside of places like Brazil, which is unsurprising, particularly given the rise that we're seeing now in inflation, and Asia, we are looking at a pretty flat policy profile for central bank interest rates for as far as the eye can see. I don't think anyone can really imagine beyond 3 years. I'm sure actually that for a lot of people, looking beyond the next 6 months and what happens with COVID, what happens with politics around the world is probably already quite challenging. But so basically, we're talking about a steady interest rate environment. And that's very important to bear in mind, simply for the fact that it means for investors, they don't really need to worry about one of the key variables in most models, which is official policy rates. So that's not a big issue. The second chart today is one from the Lipper fund flow data that we get. It's the monthly data on flows into global funds. And I bring it up merely for the fact that actually what it highlights is that going into the election, as opposed to the events which surrounded us back in the March through August period, actually the flows into funds have actually been fairly insignificant. Therefore, one needs to bear in mind here that this is that people have not actually necessarily been putting a lot of bets in terms of actual cash funds onto this. So that's an important point to bear in mind, given the price action that we've seen in the wake of the election. Now, on Monday and Tuesday, basically what we had, and we can see it in both the US Treasury chart, 10-year yield chart, and indeed the S&P 500 charts, which will follow. The first one is the US 10-year chart. We had a narrative whereby that we were going to have a lot higher yields because we were going to have a big spending blue wave, Democrats taking everything. And indeed, what's happened in the meantime is actually what we've got is a situation which looks, but is not guaranteed to be a gridlock situation in the US, i.e. no overall control, so no one can actually enact anything particularly large. And then in terms of the S&P 500, a very similar story. That basically on Monday and Tuesday, big spending, big fiscal package was basically good news for the market. And then as of Wednesday, actually gridlock is also good news for the market. So we're making it up any way which way we can.
4 minutes.
Gridlock is good simply because no one can actually enact anything crazy. And that should be basically good for risk assets. So what's really the story here? And I think really this is why I've put both of those charts up against their respective volatility indices. And that is basically the market's actually being driven by the positioning and unwinding of positions in the options market. And therefore, really what we've got a story here is not necessarily anything to do with the political situation, which remains uncertainty, but effectively the derivative market wagging the tail of indices and indeed yields. And therefore, the most important thing now is to remember that some of the narratives that we're pinning to these moves is not necessarily the correct one. Those are the thoughts for this week.